everyone, Rosie here. So I've worked with IFRS in practice for many years now, and I've also marked professional accounting exams. So on this channel, what I do is break down complex accounting standards and explain the real logic behind them so they actually make sense for you in your SBR exam. So let's go. So this week's topic is sale and leaseback, and why, from a real economics perspective, we don't recognise that full gain on that disposal. So I want to help you understand what is actually happening commercially, so the proportional measurement rule becomes more obvious rather than just memorised. Sale and leaseback is one of those areas that students often find difficult, and they often memorise lots of different rules but don't actually really understand why. So you sell an asset, you receive cash. So naturally the instinct is, well, I sold it, so I recognise the gain, as we would naturally on most of our assets. But IFRS 16 actually says no, only part of that gain is recognised under these circumstances. So why? Why might that be? Well, let's think about what's actually happening economically on a sale and leaseback, because once you understand what's happening, that accounting treatment actually does become really logical. So stepping back, looking at the whole picture, a sale and leaseback has two linked transactions. So first, the company sells the asset to another party. And then secondly, the company immediately leases that same asset back. Okay, so those two transactions. So the company receives cash today, but it continues to use the asset in its business as it always has. And this is quite common in practice in real life. So think about airlines, quite a lot of the time, aircrafts, this is what happens. Also retailers with buildings, that sort of thing. And what it does is it allows companies to unlock cash from its assets, from that aircraft or from that building, while it still continues to operate in a normal way. So thinking about that, the real question that IFRS 16 asks is, did the company actually give up the economic benefits of that asset? Okay, it all revolves around this question. So if the answer were yes, we give up the economic benefits, then recognising that full gain would make sense. Okay, we're not going to get any benefit from that asset in the future. However, in a sale and leaseback, the company does still control the right to use that asset for the lease term. They're still generating revenue from it and generating profits. So economically, they haven't disposed of that entire asset. Yeah, they've only sold one part of it that has the rights attached to it. So a really helpful way to think about this is that think about the asset as a bundle of rights. Okay, don't think of it as what it is, think of it as a bundle of rights. So owning an asset gives you different types of economic rights. Okay, you've got the right to own it, you've got the right to use it, and you've got the right to sell it. Okay, in a sale and leaseback, those rights are split down, they're carved out. Okay, so ownership transfers to the buyer. Yeah, we no longer own it, it transfers to the buyer. But us, as the seller, keeps the right to use that asset through the lease. Okay, so economically, the seller, us, has only transferred part of that asset's value. All right, and in accounting world, substance over form, the accounting needs to reflect those right transfers. So let's imagine if a company sold a building for 10 million and then immediately leased it back for the next 20 years. Okay, they've unlocked some cash to be able to do what they want with it. If they recognise that full gain straight away, it would look like the company created a huge profit on the sale of a building. Yeah, but in reality, the company is still using that building to run its business as it always did. It hasn't really exited the asset economically. Yeah, so recognizing that full gain would exaggerate the performance of the business. They would be reporting higher profits. Yeah, so instead, IFRS 16 only allows the company to recognize the gain that relates to the portion of the rights that has actually transferred. So IFRS 16 ultimately reflects the economic reality by splitting out and carving down that transaction. The company recognises a lease liability because now it has those future lease payments. It's got the obligation of that. And it also recognises a right of use asset representing the rights that it has kept as part of that transaction. And that gain, that difference, is only restricted to the portion of the asset that was actually transferred to the buyer. So instead of saying the whole asset was sold, what the accounting does is it recognises that part of it is still effectively being used by the company. Now, a key question that always comes up often with my students when I'm mentoring is why the right of use asset is measured as a proportion of the original asset's carrying value. It seems a little bit odd. Why don't we just measure it using the present value of the future lease payments like a normal lease? Yeah, that's a valid question to ask. Now, the reason is because this isn't a completely new asset. We had that asset before, okay? It represents the portion of the original asset that the company continues to control ultimately. So the accounting keeps a portion of that original carrying amount to represent the right that they have retained. And this prevents companies from recognizing artificial gains and inflating their profits ultimately across the period. So let's have a look at a little example. So let's say an asset had a carrying value of 100 and we sold it for 120. So if that was a genuine sale, we'd have a gain of 20. But because the company continues using that asset through the lease, it hasn't transferred the entire economic value. So IFRS 16 only recognises the gain relating to the portion of the asset sold. So the rest of the gain is effectively deferred through the right of use asset. Yeah, that's what we're doing. And what that does is it aligns the profit recognition with the economic reality of what's happening. So what we need to remember is you sold the ownership, but you kept the use. Okay, so you cannot recognize the full gain. And if you think about that one idea, it explains really the entire rule and the entire substance behind the transaction. In the exam then, what tends to happen, what I've seen, is students often jump straight into the calculations of this. But what the examiner wants to see in the exam is that you actually understand the economic substance behind this transaction. Yeah, the maths isn't hard. It's understanding what's going on that is difficult. So you need to explain that the seller retains those usage rights, and you need to explain that the only rights transferred generate the gain. Okay, that reasoning is where you're going to gain marks, and particularly those professional marks when you really do understand the commercial substance behind it. So there we have it. So a lot of IFRS rules do look really strange until you start to think about the economics behind them. And that's exactly the same with sale and leaseback. Yeah, it's really just accounting recognizing that the company didn't give up that whole asset. Thanks for watching. Hopefully that made the logic behind that standard just a little bit clearer for you. If you found it useful, subscribe for more short SBR technical deep dives. I do post new ones every week. And if you're struggling for SBR and do want support turning that technical knowledge into exam marks, you can find details of my mentoring in the description below. See you on the next one.